All right, let's set the scene. Picture this. You wake up on December 26th, 2025, and the financial markets are going absolutely wild. But the cause? It isn't some hot tech stock or a new crypto coin. Nope. It's one of the world's oldest metals, silver. And what happened next? Well, absolutely nobody saw it coming.
This is what traders saw on their screens. A massive, jaw-dropping 11% surge in a single day. The price didn't just climb. No, it was a vertical takeoff, just shooting straight up, smashing through records to hit nearly $80 an ounce. Now, in the world of commodities, a move this violent, this fast, is practically unheard of.
And get this, that one insane day, it was just the explosive grand finale to an absolutely incredible year. To put that in perspective for you, silver's price had already soared a staggering 160% throughout 2025. It climbed all the way from about $30 an ounce. I mean, that's a performance that left most other investments, including the S&P 500, completely in the dust.
So you can imagine, the entire market was left scratching its head and asking one simple question, the same one we're here to answer. What on earth just happened?
The first term that all the experts and analysts started shouting to explain the chaos was a powerful and really volatile market event known as a short squeeze.
So what exactly is that? Well, to put it simply, a short squeeze is what happens when investors who are betting on a price to drop get proven spectacularly wrong. The price shoots up, they start losing a ton of money, and they're forced to panic buy the asset just to stop the bleeding. And that huge wave of forced buying is what sends the price into complete overdrive.
And if this all sounds a little familiar to you, it absolutely should. This is the exact same mechanism, the same kind of self-feeding frenzy that famously sent GameStop stock to the moon back in 2021. It's a really powerful feedback loop.
So here's how that spiral works. It starts with a bunch of people betting the price will fall. But then an unexpected wave of buying pushes the price up. All those short sellers start bleeding money, and they're forced to buy just to stop the pain. And all of that forced buying, it acts like rocket fuel, sending the price absolutely parabolic.
But here's the crucial point. A short squeeze doesn't just happen in a vacuum. It was just the spark that lit the fuse. The real story, the one we're about to unpack, is about the four powerful forces that spent an entire year building the tinderbox.
Okay, driver number one, and this might be the most critical piece of the puzzle. It was a simple physical problem. The world was running out of silver that was actually ready to be delivered. The vaults were literally emptying.
And you can see the proof right here in the data from the world's most important exchanges. On the left, you see the COMEX vaults in New York. Look at that sharp, sudden drop in inventory. It's like it fell off a cliff. And on the right, the Shanghai Futures Exchange is hitting its lowest level of the year. This wasn't a local issue. It was a synchronized global inventory collapse.
Now, at the exact same time that physical supply was getting super tight, our second driver kicked in. A massive rush of investment demand pouring in from every single corner of the market.
So who was buying? Well, pretty much everybody. You had the big money institutional investors piling into SLV, the world's biggest silver fund, pushing its physical holdings to a new record high of over 16,500 tons. And at the same time, on the other side of the globe, silver became known as the poor man's gold in India, with imports there jumping a massive 40% year over year.
Our third driver requires us to zoom out a bit to the bigger picture. The entire global macroeconomic and geopolitical climate was a perfect storm, and it was pushing investors toward the safety of precious metals.
It really was a perfect macro storm. Geopolitical conflicts were on the rise, increasing demand for safe havens. At the same time, the U.S. Federal Reserve was cutting interest rates, which weakened the dollar and pushed investors to look for a hedge against inflation. Now, with gold prices already at historic highs, a torrent of all that nervous capital flowed into the much smaller and previously undervalued silver market.
And that brings us to the fourth and final driver, which you could argue is the most important of all. This is the unbreakable floor of demand for silver that simply cannot be negotiated away.
To see what we mean, just look at solar power. Back in 2015, solar panels consumed just over 5% of all silver. By 2025, that share had tripled to 17%. Think about that. The global green energy transition is literally being built with silver.
And the key word here is inelastic. What that means is the demand from solar panels, AI servers, and all our other high-end electronics is non-negotiable. Why? Because for these critical technologies, there just aren't any cheap or effective substitutes for silver. This demand isn't optional. It's essential.
So what's the result when you combine all these forces? A massive supply deficit. In 2025, the world was projected to need 149 million more ounces of silver than it actually produced. That's a shortfall equal to 15% of the entire planet's annual production. Just a staggering number.
So when you put it all together, you see that this price explosion wasn't about just one thing. It was the violent convergence of all these powerful global forces, creating what can only be described as a perfect storm. So let's recap those four forces. First, draining inventories meant physical supply became critically scarce. Second, surging investment from Wall Street all the way to Main Street created a buying frenzy. Third, global instability pushed investors towards safety, and they chose silver as an alternative to pricey gold. And finally, the insatiable hunger from the tech and solar industries created a relentless baseline of demand that just couldn't be ignored.
So, the crucial point, the main takeaway here is this. The great silver squeeze of 2025 wasn't some random market fluke. It was the logical conclusion of all these deep intersecting trends. It was the market fundamentally repricing a resource that is both a monetary metal and an indispensable strategic commodity. However, it is absolutely critical to remember a note of caution here. For the average investor, this kind of volatility is a double-edged sword. Violent surges like this are very often followed by sharp, painful pullbacks. You always have to remember, extreme rewards almost always come with extreme risk.
Which leaves us with one final provocative question to think about. With global inventory still sitting near historic lows and that non-negotiable industrial demand locked in for years and years to come, you have to wonder, is silver's explosive story just beginning?